Welcome to episode 6 of the Chartered Show. With the markets in turmoil, today I've asked two guests to join me. The first being Victoria Reuvers, MD of Morningstar South Africa, and the second is Stephanie Bakhuis, Retirement Specialist at Chartered Wealth Solutions. I do believe the insights that they're going to share with you are going to help you to get through this turbulent time. Chartered Show today, I'm going to be interviewing Victoria Reuvers, MD of Morningstar South Africa. Now, Morningstar are our investment consultants, and I thought it would be great for Victoria to share a little bit more about what Morningstar is doing, because we all know in times like this, we need information. And the reason we need information is because if we don't have it, we start to think we should become the investment consultants and we should be doing things with our portfolios. So Victoria, we had a really interesting presentation from you today, which I am going to put the link on for anybody watching us, that they can watch the whole presentation of 55 minutes. But I thought what would be important for you to share with us today is that you at Morningstar are doing things with the investments. It's not that advice that you're giving us to sit on our hands and not doing anything. You are doing things for us.
Absolutely, Kim. And we do a lot in good time markets as well as in bad markets. And I used a Warren Buffett quote in the presentation, which was that a few things in life are more emotion laden than our relationship to money. And I think it would be unnatural to think people are not worried right now. And the natural reaction is to call you and say, should we be doing something? What should I be doing? And I want to give comfort to everybody listening to this that from a Morningstar perspective, we are very active in what we're doing. So when markets are good, we're looking to find opportunities where we can take profits and invest that on a forward-looking basis. When markets are bad like they are now, our job's actually a lot easier, because from an investment perspective, you're buying into companies. And while industries, in times of recession, companies might go out of business, industries don't. And so we need to find really good businesses that can survive a recession, that potentially can survive in a rising interest rate environment and in a higher inflationary environment. So right now, where we're seeing good value is in select global equities, in South African equities, in South African government bonds. And from a portfolio positioning perspective, we're being very active in ensuring that all investors in our portfolios get good allocations to areas of the market that are looking very cheap. Now, value certainly exists, but value is a very poor timing tool in terms of when returns come, but it's a great tool in generating long-term real returns and real wealth for investors. So for investors entering the market now, they might feel terrified when they look at fact sheets of what returns have been over the last 6 months, but it's a very good entry point if you want to generate wealth on a forward-looking basis. And for investors in the market, if you're thinking they should be doing something, don't worry. If your time horizon hasn't changed, don't do anything. We're doing stuff with the portfolios to make sure we can take advantage of opportunities.
So it's nice knowing that you're doing things for us. But I think at the same time, we like a little bit more information, because most people, we have stories going on in our head. And the thing is, when we don't have the information, we have these parts missing, and then we start making up information. And as much as you're telling us not to do anything and that you've got it all, I think maybe if you could explain a little bit more to us of what you see actually going on in the economy. I know for me, I've just come back from the States, and people say to me, so what did you pick up that was different this time from the last time? And it had to be that at every single shop, there was a sign up, vacancy, help wanted. And I often think about South Africa, where we have this huge unemployment rate, and yet there in America, they're looking for it. Now, is this impacting our investments at the moment?
Absolutely. And the biggest factor driving markets at the moment is the very high inflation rate in the US and actually around the world In the US, inflation's at 9.1%. Last recorded in the 70s, a level of that high. And so what that means is that interest rates are being raised around the world. As you raise interest rates, it often creates a recession as you take liquidity out of the system. But what is very interesting about this time round is what's driving inflation. So it started with the COVID shock in terms of the supply shock we saw, and then the war in Ukraine meant that oil prices went to over $100 a barrel. That caused inflation. Those two are starting to roll over. What's really driving inflation right now is wage inflation in the US. And Kim, you mentioned South Africa, where we've got huge unemployment, and it's devastating because we have unemployment numbers around over 30%. But here's a stat for you. In the US, for every one person looking for a job, there are 2 jobs available. And that means
South Africa's dream.
Yeah, right. But that means that wage inflation, prices, employers are having to offer a lot more in terms of salaries to entice people to work for them. And why is this the case? Well, prior to COVID, an interesting statistic that came out of the States was that the highest age group of the market that was being employed was individuals between 65 and 70. The next highest age group was 60 to 65. And so what happened in COVID was when people got locked down and they got TERS checks from the government, that area of the market said, you know what, I'm not going back to work. I don't need to work anymore. I've got good savings. I've received money from the government, and actually I don't feel like working anymore. So there's a huge area of the market that was supplied, had a workforce that no longer exists. The second interesting fact is that the number of individuals in America between the age of 25 and 35 that live at home is 30%. So 1 in 3 individuals under 35 working in age lives with their parents. And that number's increased from around 10%.
So are you saying that that age group, are they not working?
They're not working, and they're happy to live at home with their folks and whatever it is they do. And those were actually the parents that were probably working to support their individuals at home. So you've got a large segment of the market that doesn't want to return to the workforce, the older population, and a large segment that actually doesn't want to enter the workforce.
And that's all affecting our inflation rate.
Absolutely. So that's driving inflation in the US at the moment. You're seeing interest rates being raised. They've had 150 basis points rise in the last 3 months. And that obviously impacts South Africa as well. When there's a global recession, mainly driven by the US, we're not immune to that.
We seem to be affected, or whatever's happening anywhere in the world,
Sure.
And what's happening in South Africa, we seem to get affected. But that said, and thank you for just, it's like making what I saw, making me understand what was going on, because I thought it was really strange. But I think maybe if you could share some tips with us, because you've told us now Morningstar are taking care of a whole lot. We're saying, we as the planners at Chartered Wealth are there to support you. But what should the clients be doing? And maybe have you got some tips for them what they could be doing in times like this, since they shouldn't be changing their investments. We're asking you not to panic, but what could they be doing?
Sure. So the first thing is to say the system we work in financial services is quite bizarre, and it's almost designed to shock. So if you're an investor, you must probably be receiving your quarter end statement, which was for data till the end of June. Absolutely terrible. Markets, there was a synchronized sell-off in equities and bonds. Nobody and no market was spared. But July was a fantastic month. Markets were up almost 10%. But you'll be looking at data as at the end of June and probably feeling either pretty angry, pretty panicked, or pretty worried. And all of those are completely natural reactions. So absolutely phone your planner at Chartered Wealth and get some advice from them on what to do. Know that investing is a marathon and not a sprint. Know that you're in it for the long term, and prices move in anticipation ahead of the market, and the pendulum tends to swing too far to the one way and to the other. So right now the pendulum has swung so far, and you're getting the opportunity to actually invest at very cheap rates. I like to say if there was a sale, a 50% sale at Woolies, we'd rush in to buy things. But when there's a 50% sale in the stock market, we want to exit and sell and lock in those losses. So know that this is a natural part of our economic cycle, and this is what happens with markets. Almost every 7 to 10 years, we go through this economic cycle. So call your advisor, get some advice. Do not worry about sensational headlines. That is what news flow is there for. Maybe great to talk around the dinner table. If you know a fact that's sensational and in the news, trust me, it's already in the price of your investment. The other thing is to understand the investment process. Luck can perform in the short term, but the only thing that performs in the long term is a disciplined and robust investment process, which you guys have, which is great. And then remain diversified, so don't try and bet the farm. It's often at times like this where people want to take on a bit more risk and really, as I say, bet the farm on one outcome. Diversification might seem silly in the short run, but it absolutely is your friend in the long run. And lastly, if you get advice to sit on your hands, take that advice. It is the best advice that you will get, because these markets will correct, and this is the time when long-term wealth is created by investing at these levels.
Well, thank you very much for confirming what we are sharing with our clients, because it is important for us also to have your support, knowing that you're doing what needs to be done in order for us to do our role of actually supporting our clients and getting them to stay sitting on their hands. But I think just one final thing, if we look forward, as you said, markets are forward looking, and if you had to, and I know you don't have that telescope and you don't know crystal ball exactly what's going to be happening, but are we seeing any green shoots? Are we seeing any signs that things could be changing?
Well, the market's absolutely priced in a recession, and so that is in the price of the market. And what we need to look for is you need inflation to start to roll over. So what's that US inflation number? It's currently 9.1%. It needs to start coming down. You need to start seeing unemployment rise. Actually, you need to see people start losing their job in the States. And so that actually takes some of the heat out of the economy. And if those two things start to happen, because markets are forward-looking, the markets have priced in all of this bad news and a recession. We're technically in a recession in the US, and as soon as the green shoots of all that bad news starts to come to fruition, markets will start to say, right, the next leg from here is probably a rate cut and things will start to improve. So I think the next 6 months will probably be quite tough. Who knows? It all depends on whether there'll be a soft landing or a hard landing, but it's in the price. So what you own and what you hold now has got all that bad news in the price already. So as the bad news comes, you'll actually start to see markets price in good news going forward.
Thank you, Victoria, very much for sharing with us.
Pleasure.
And I look forward to having more talks with you about the markets, because I think it's really important that we get regular updates, because the more regular updates we're getting, the more we can understand what's going on, and potentially those conversations at our dinner parties or with friends of ours might just not have that effect on us that they would have if we didn't have the information. So thanks so much.
Absolutely, and these are extraordinary times. So this is when you want to ask the questions. Got to get the facts.
My guest on the Chartered Show today is Stephanie Bakhuis, Retiremeant Specialist Stephanie Solutions. Welcome, Steph.
Thank you, Kim, and thanks for having me today.
It's a pleasure, and I think a big reason why I asked you to be on the show today is you've got some great things happening in your life. I mean, there's not many people I know at the moment that have got good news stories, and Steph really does have some good news stories. So just to reiterate a few of your good news stories for the clients that don't know about it, Steph was made the director of Wellstrat at Chartered Wealth Solutions. Congrats on that, Steph.
Thank you, Kim.
The same week, she found out that she'd passed her CFA exams. Now, for any of you out there, these are one of the hardest exams to pass. Congrats again, Steph.
Thank you, Kim.
And a little birdie tells me that it's like 4 months to go until you get married.
Correct, Kim. I'm having a hell of a year, and just feeling so blessed from like all directions of my life at this point in time. And really in a world where I think everybody's going through a lot, it's just so nice to have good things happening out there.
And I think for me very much, it is just lovely to share some good news, because there is a hell of a lot going on. It seems like really turmoil times. We kind of came through COVID, and I know for myself, I was expecting to pat myself on the back and say, well done, Kim, you got through this period.
Yeah.
And I thought a rainbow was going to appear.
Yeah.
But instead what appeared was a war and load shedding and political unrest. And kind of it's taking us a little bit of a back step, and we're going, so now what? Where do we dig in to find these kind of resilience to get through this all? And that's, again, another reason I asked you, not just the good news stories, but maybe just to share with us some of the insights that you've got from some of these kind of conversations that you're having with your clients at the moment.
Sure. Thank you, Kim. And I think what I'm seeing happen at the moment is that we've all already just come out of such a tough time. You know, we've been locked up in our houses. We forget that just what is it? Not even 2 years ago, or 2 years ago, we were all running marathons and 5Ks in small loops in our houses and doing ridiculous things like that. And we finally thought that we were kind of out of the woods and life was returning to normal. And as much as life in general is a lot more normal, we're now dealing with all of this. So what I'm seeing from clients at the moment is really just a lot of panic, and I think a lot of uncertainty, because we've just come out of a really tough time and now we're straight back into another one.
And I think with that, we've got a lot of emotions that are happening with us. And I mean, from a point of view of money, we know money is one of the most, it's something that brings out, it triggers a lot of emotions in us.
Yeah.
And the clients are receiving their statements. How's that going?
So I think the receiving statements, there's no question in anybody's mind that when you get a statement and it's gone downwards, doesn't matter how far down it is, it never feels great. And so what I'm seeing a lot is that clients are kind of asking the questions, well, if my money's gone backwards, how much more backwards is it going to go? How much further down do we have to go here? Am I still okay? Is my graph still okay? Let's check in. Where are we? When are things going to turn around? And so there's a lot of questions that we're asking ourselves, and I think it's often, there's a particular bias when it comes to investing called a recency bias. And what that really means is that we tend to carry the most recent events with us in terms of how we feel and what we expect in terms of what's going forward. And so I'd encourage everybody to, and all of our clients to remind themselves that when we really look at the long term, these events that we go through are actually just really tiny in the greater scheme of things, and not to focus on what's happened more recently, but to rather look forward, because markets are ultimately forward looking.
And I think with that, I mean, what happens is you see your statement and then you go, well, is this going to be what's going to happen forever? And what should I be doing? Because I think for most of us, when we're in this kind of, you see it, you want to take action. What could I be doing to take action? So what is the kind of action you recommending people do when they see their statements have gone down?
Absolutely nothing, Kim.
Oh, that's great advice. Just do nothing. I would challenge that, and I would say that's what we're here for.
Yeah, 100%. And I do have more. That's the
Okay.
that's the simple that's the simple answer. The reality is that when we try to do something when there's a lot of uncertainty and markets are down, we are more likely to destroy wealth than create wealth. Some of the things that we can do is, I know that costs are going up. We've all heard inflation and things are really difficult. But some of the things we can do, and obviously being a financial planner, chartered or retirement specialist, we're very well aware that costs of things are going up, and we're starting to feel the pinch at the moment. But what we can do during these times is we can try and manage our expenses as best as possible. That's one thing that individually each investor can do at this point in time. The other thing we can do is, as an example, let's say that you are planning to replace your car this year. If your current car is still going all right, there's options like just waiting it out, that you're not drawing a sizable lump sum from your portfolio at a time when it's under a bit of pressure. So those are all things that we can do. So what our clients can do is to manage their expenses, and our jobs are to manage our clients' emotions and to, as best as possible, get our clients to sit on their hands.
But I think maybe just one word of encouragement then would be to clients, instead of thinking you need to be doing this alone, come in and see your retirement specialist, because at times like this is when we need to be supporting each other, because it's when we're alone or when we may be talking to our friends that actually, I find with people, they love to spiral down and to make it worse and to make it worse, and they can always add on. So this is a good time to come in, even if it's not your review time.
Exactly, Kim. And I'll actually just refer back to a meeting I had with a client recently, and he was so panicked. In his mind, his retirement plan had gone out the window, and that's what he told himself. That was the story in his head. And instead of having all this panic and a build-up of anxiety, we had a meeting. I said, look, come, let's sit in a boardroom, let's have a cup of coffee, let's update your graph, and I can tell you, by the time you leave the meeting, you'll be reassured that actually you are okay. And when we updated the graph with current numbers, not old numbers, current investment numbers, and we showed him his graph and he saw that he was okay, he asked me the question of, is that even after everything we've been through? And the answer was obviously yes. Even after everything we've been through, his graph was still okay. And what we have to remember is that the graph is strategic. When we run that scenario and we come to a graph, it's strategic. And when markets go through downturns, your graph might come back just a little bit. And when we go through really good times, it might go longer for a little bit. And so, but the net effect is that you are still okay. Your graph hasn't gone out the window just because we've had a market event.
But yet, when it's happening to us, we do have those, I call them money triggers, and they really trigger us because it's our worst fear with the markets going down. And I read somewhere the other day that when things are going well, it's not half as bad as when things are going badly. I think I know about it from if you ever get feedback. If you get good feedback, like I gave you good feedback at the beginning of our conversation today, you get it and you go, wow, I got some good feedback. But if I had to criticize you, it's going to have a massive impact on you.
Correct.
And am I correct? What's happening now with the markets, when it's bad, it feels even worse.
Exactly, Kim. It's actually called loss aversion. And what that means is that when that investors are far more favor getting gains than what they do losses, because they feel those losses emotionally twice as hard. And as you said, there's no emotional trigger quite as bad as money.
And it feels like pain. It's huge pain that you're getting in your body.
Absolutely. And I think it's the uncertainty that comes with it, because automatically you think, and it's that story that starts. My statement shows my money's gone down. It's going to go further. I'm going to lose all my money. And that's not a reality. That's just the story that's happening in your mind.
So again, we can't reiterate more that becomes a time when you should really be coming in, meeting with your retirement specialist. I mean, maybe just from a kind of a resource point of view, because I know there's so much news out there, and so much with the bad news out there and everybody making the predictions. I thought maybe you could just share with us some good resources that potentially people could be looking at, or maybe some slides that we have that we might be happy to share with people listening today that would be helpful.
Sure. Kim, I think the best resource I'm going to recommend is our clients' financial planners or their retirement specialists, because we have got all the slides from the likes of Morningstar that really are there to help give a sense of confidence, and I think just to ease people's minds around what's happening, where we're headed. So I think the best resource out there is actually to try and steer clear of the news, because we all know that bad news sells, good news doesn't sell. And so more of what's in the media at the moment is bad news.
And it's the past.
And it's the past. So I would encourage all our clients to see their financial planners or retirement specialists and just have a meeting, get that sense of comfort. You are okay, and markets work in cycles. What we do know is that markets will turn around. What we don't know is when. and we don't have any control over it either. So the best advice is, to kind of sum it up, is to stick to your investment strategy, manage your expenses where you can, and see your financial planner.
One last thing, and I know you said that was the ending, but one thing I just think is important to note is we will only realize the real loss if we get out of the markets. And there's very important data around if we miss the good days in the market. So maybe just on our final concluding remark, just talk me through that.
Sure, Kim. So what happens when investors become uncertain around what's happening in markets is your automatic reaction is to cash out and say, well, I'd rather not suffer any more losses, I'd rather just put my money in cash. And then what happens is you try and take a bet on when the next best time might be to enter the market. And so what a study that we've seen has actually showed is that, and it was based on some data going back to the late 90s, if you had put money into the market, let's say that you put 1,000 Rand in, today your money would be worth in excess of 15,000 Rand if you just left it, didn't touch it.
Bad times, good times.
Bad times, good times, you did what I've just said and you sat on your hands. And if by trying to time the market by going in and out, you missed the 25 best days, and this is over almost 7,000 trading days, your money would be almost half of that value. And that really just highlights the importance of sticking to your investment strategy through both good times and bad times.
So actually what you're telling me is it's often the behavior more than the investment's returns.
Without a doubt.
Thank you very much, Steph. Thank you for joining us for the Chartered Show. Please feel free to like, comment or share, and we look forward to hosting you next month.